Hi, I'm Paul Bosley and I'm the owner of Business Finance Depot. And I'd like to welcome you to our series, Financing for Your Business Success. We've developed a series that show you how to prepare for underwriting and all the different types of loans and leases that are available to you to finance your business. We hope you enjoy the series. In this segment, we're going to talk about equipment leasing. What a lot of people don't realize is there's more money transacted every year in equipment leases than there are in loans. You've never flown on an airplane that's not leased. Whenever you go by a construction site, all that construction equipment, it's leased. How many times do you see a commercial and they talk about auto leases? Auto leases are operating leases. So at the end of the lease, you give the car back and you get another car. But when you're leasing equipment for a new business, that's a capital lease. And a capital lease is the type of a lease that basically at the end of the lease, you own the equipment. So if you're opening up a franchise or a fitness center, at the end of the lease term, you own the equipment that you leased. So all you're really doing is you're using somebody else's money to finance the equipment that you need to run your business. Well, why do you do that? What's the benefits of doing that? Well, the biggest benefit of doing it is it's fast. Getting a lease application approved takes a day. Getting it funded takes really just as long as it takes to deliver the equipment. So one of the things that people like about equipment leasing is it's fast. The second reason is you preserve your own capital. So instead of spending $100,000 on new equipment, let's just say, instead of that, you're only going to put 20% down. So in that example, instead of spending $100,000, you're going to spend $20,000, and you're going to finance the other $80,000 over the term of the lease. So you're preserving that other $80,000. Hopefully you don't keep it under your mattress and you put it to work for you so you earn some interest. So the second reason is it preserves your capital. The third reason is whenever you make a lease payment, it's a tax-deductible item, just like when you write a rent check to your landlord. When you write a rent check to the equipment leasing company, it's a deductible item. So when you write those checks, you're lowering your taxable income, which is in turn going to lower the amount of tax you pay to the federal government on a profitable corporation. And then finally, you're building business credit. One of the things that's important about leases is that once you start to pay lease payments, the people that you're paying the lease payments to are going to report you to Dun & Bradstreet or to Experian Business, which we talked about in an earlier segment. So the important thing about understanding all this about leasing is that it's a way to preserve your cash and it's a way to build business credit, but it also lowers your taxes. And one last thing that a lot of people don't realize, when you do an equipment lease, you can accelerate your depreciation. The IRS has a 159 clause that allows you to accelerate the depreciation. So I'll use an example. Let's just say that lease that we talked about for $80,000. And let's just say you make $60,000 of profit in any given year. So if you accelerate the depreciation on the lease, you can wipe out the profit by accelerating the depreciation so you don't pay any taxes at all. The idea behind equipment leasing is to use somebody else's money to get the equipment you need, to lower your taxable income, and to run your business on leased equipment. If you need any more information, please visit us online at www.businessfinancedepot.com or email me at paul@businessfinancedepot.com. Thank you for listening.